All right, so let's get started. Welcome to Texas Real Estate Today. My name is Wes Miller, and I'm a research associate at the Real Estate Center at Texas A&M University. Today, we're going to talk about the housing market and how it's been impacted by the COVID-19 pandemic. Joining us here in the discussion is our Chief Economist, Dr. Jim Gaines.
Good morning.
And one of our research economists, Dr. Luis Torres.
Good morning.
I encourage the audience to post any feedback and questions in the comment section on any of our social media platforms. We'll try to address these questions during the show, and anything we don't get to, we'll post links and additional information afterwards. So let's get started. Dr. Torres, how was the housing market impacted initially by COVID-19, and how have things progressed over the past 6 and 7 months?
So when the pandemic hit, like any other sector, we shut down, right? The economy completely shut down. We were suffering like a self-induced coma, right? So nothing was open. You know, there was social distancing. Everybody was in their homes, and that completely closed the housing market in that moment, right? There was no sales activity. There was no people going out showing houses or buying houses. Also, if you had the uncertainty initially, it was kind of difficult to think about, I'm going to buy a home right now when I don't know what's going to happen in the next couple of months, right? So of course, for the first 2 months during the shutdown, the housing market was hit hard, like any other sector, like the rest of the economy. But then, as we opened up the economy, right, we had all this pent-up demand before that. And if you add that the people that are actually purchasing a home weren't as affected as other sectors of the economy, you know, a lot of these people that, you know, the people that have been hit the most by the pandemic work in services that cannot social distance. Also, another trait of those people that were hurt were people that have lower education, lower skills, and earn lower wages. Think about leisure hospitality. Leisure hospitality, a worker there earns around $17 an hour. If you add it up annually, it's around $25,000 of earnings. So you have that sector. But people that can purchase a home, you know, have higher skills, basically education, where they work at, they could work from home. So that allowed them, you know, to go ahead and purchase a home going forward. So we saw this, it's surprisingly good that we've seen that the progression of the home sales and the market is doing really well. It's one of the bright spots right now of the recovery with respect to other sectors in the economy.
Yeah, Dr. Gaines, so now that we've had this pent-up demand, you know, been released during the summer months, what explains the housing market's resiliency now as we are in the third quarter and heading into the fourth quarter?
Right. Well, as Dr. Torres was saying, when everything stopped and slowed down back in March, April, May of this year, the housing market, like everything else, stopped. People stopped buying and so forth. That demand got pushed through the system, if you will, into June, July, and even into August. One of the other things that was going on simultaneous with the pandemic, of course, and this is well known, is of course the very dramatic fall and decline in mortgage interest rates and mortgage lending. The mortgage interest rate right now nationally is less than 3%, and in fact it's possible if you go for a 15-year mortgage to get mortgage financing at less than 2 3/4. So the mortgage interest rate has been a magnet, if you will, pulling forward some of the demand that might have gotten postponed for 6 months or a year out is being pulled into the current time period. Also, our normal seasonality. Normally we find the second and third quarters of the year. The second quarter is the slow emergence of the market. Third quarter, the housing market in Texas and the U.S. for that matter peaks, and then the fourth quarter drops off. What we're beginning to see already, early evidence is that the fourth quarter is not going to drop off as much as some of this demand from the future is pulled into this year. It'll be debatable what happens 2021. I'm sure you're going to ask me that one in a minute, but we'll have to see how that's going. The other thing that's going on, we should mention, and the importance of the housing to the overall economy is home construction. We're seeing almost record, near record levels of construction, record of the last 7 or 8 years. Not equal to what we did just before the Great Recession in 2004, 5, 6, but the best we've done in the last 10 years or so in terms of annual rates of new housing starts, permits, and construction activity. It's been amazing that the demand has been so strong to pull that, and that's one of the big multipliers into the overall economy, which is from home construction.
Yeah, back to you, Dr. Torres. We've discussed this, this stimulation and this strong, resilient demand. We've talked about new home construction. What's been happening in terms of existing homes and new homes hitting the market and listings in Texas?
So I think that's one of the issues we have facing going forward, right? The lack of new listings and the low months of inventory. And this is one of the things that was prevalent even before COVID-19. We saw that in Texas the housing market was doing really well. We actually were expecting a great year for 2020 for the housing market before the COVID-19 hit the economy. But that's an issue that became a bigger issue after COVID-19, right? We have such historical low months of inventory, especially for the lower price ranges, for homes below $300,000 for the starter homes. So that's I think it's a headwind in a certain way that could be holding back the housing market going forward.
And what are the price implications of this? We've got strong demand, we've had limited supply and new listings. What are we seeing on the price front here?
So we're seeing an increase in prices, strong price growth. Just to mention here at the center, when the pandemic hit, I think all of us at the center we were asked this question: what's going to happen to home prices, right? And we said we don't expect home prices to fall. And I think we were right with that forecast. So again, you see that market equilibrium, and you see just strong demand and supply. Again, Jim talked about supply, and we've seen that problem even in the new home construction even before the pandemic, and it became worse after the pandemic. We've talked about this, discussed this, the 4 L's that the home builders have been facing: lumber, labor shortages, land, lending, ADC loans, and also laws and regulations. Those are the things that have affected the case of the new home construction, the supply of new homes. But again, the existing homes also, the problem here is that the listings are kind of lagging behind. We have months of inventories where demand continues to be so strong, and that's pushed up prices.
Yeah, we can expect to still continue to see that. For those of you who monitor our Real Estate Center website and look at average and median prices, you're going to see over the last several months there's been very high level percentage rates of increase in both the average and the median price, approaching double digits in some of our market areas. We're also looking, though, at a repeat sales index, which is also on our website that you're invited to go look at, as well as prices per square foot, and even those measures, which are generally more conservative and more representative of the overall market, even those are up anywhere from 5 to 6 to 7%. So we are seeing that. One other impact of the pandemic that's been interesting to observe and why the demand would be so strong is that people are looking for more space, different houses, and maybe to get out of the smaller apartment market and move into a house, maybe in preparation for the next pandemic. It's one of those things trying to extrapolate a little bit, but the demand, the question we're often asked is, how can the demand be so strong and why is it keeping pace? And Texas and most of our metropolitan areas in Texas have not been as hard hit in terms of job layoffs and so forth. And even the jobs that have been reduced, as Dr. Torres was talking about, were in the services industries, the personal services and so forth, restaurants, hospitality, spas, recreation areas and so forth. Most of those people tend to be renters. The people who have kept their jobs and are still working, which incidentally is close over to 90% of the workers in Texas, are still active. Incomes have been keeping up, and so that is creating that demand, and the pandemic has created the demand for more livable space, and we're beginning to see the early evidence of maybe even moving more towards suburbs. If more of us are going to be working from home, working remotely, then you don't need to be necessarily as close in and tied to a downtown or a central workplace location. You can move a little further out. That's an experience especially being seen around the country in our major urban markets like New York and San Francisco and Los Angeles and others, but we'll probably see some evidence of that here in Texas as well, particularly in the Houston, Dallas, Austin, San Antonio markets on a go-forward basis.
Now, staying on the topic of price appreciation that we're seeing now, what are the implications for Texas's affordability advantages and possibly inequality in the state of Texas?
Texas is still probably the most affordable major state in the union. I mean, those of us who we live here and we see the prices going up and we do see an issue with affordability coming. But I can tell you, if you compare home prices in Texas and in our major metropolitan markets or in our micropolitan markets, we are still very competitively priced on a national basis. It is true, though, that as the home prices increase at the local level, affordability becomes an issue. Then it's a matter of can incomes keep pace with the change in the price of the house. And so far, the increase in price of house has been outpacing the increase in income. So we are going to start seeing some tightness in that affordability issue. It's an issue that will not go away. It's going to become more pronounced as homes become more expensive. The cost is to build new homes, as Dr. Torres was just explaining, with lumber costs, land costs, labor costs, and so forth, increasing the cost of new home construction. That is still going to be an issue that's going to have to be addressed.
And we talked about how jobs have reacted in the state of Texas during the pandemic. But Dr. Torres, can you give us an idea of how incomes have reacted and income levels throughout the state of Texas have adjusted and how that's been important for the housing market?
So here the fiscal stimulus, I think, has worked. The idea behind the fiscal stimulus, what the government's trying to do, is create a bridge, right? When we were shut down, people couldn't go to work, right? So a lot of people were losing their income. So what the government tried to do is, with that check they sent out and all the other fiscal policies they implemented, was to give us that bridge, and we received a lot of transfer payments. So normally, this is really surprising. Normally, when you have a recession, because we're in a current recession, right? One of the first things that goes down are income levels, and we didn't see that we're not seeing that during this recession. Why is that? Because of the transfer payments from the government. All the money we got from the government, the help we got from the government, the assistance we got from the government. And that allowed incomes to not fall and actually increased They actually increased during the pandemic. This is surprising. But, also this has other effects, right? Think about the multiplier effects. Because if incomes don't go down, right, you still have a certain level of consumption you're going to maintain, right? So you're going to demand especially it's difficult to demand services because of social distancing, but you're going to demand goods, and that's going to still make the economy to continue to be active, there be movement, churning in the economy. So that's another benefit we got from that fiscal stimulus.
In addition to the labor market, what other areas of the economy are we closely tracking that we find particularly important for the housing market? Dr. Torres?
So again, I think Jim mentioned that. We also track the interest rates. I think it's important. We have discussion, the fiscal policy. I kind of talked about what happened with fiscal policy, the government, but also what's happening with interest rates and what do we expect. Jim mentioned this. The pent-up demand helped a lot initially to recover from the pandemic after the economy opened. But after that, definitely interest rates have helped out to continue that pro growth in the housing market. So that's a really important part of it. Also, what's happening with liquidity in the markets? How's the financial markets? Are loans still being processed? Now, going back to the interest rates, it's really important. One thing we track, it's what's happening with inflation. Are we actually going to have inflation in the medium long term? Because that's going to have a big impact in mortgage rates and the housing market. So those are the things we continue to track. And also, of course, new home construction. We look at what's happening with the home construction. We have this indicator that you look at our website. We have a leading indicator for home construction in the state of Texas. And right now, it's pointing toward more growth, more construction here in the Texas economy.
Now, staying with you, Dr. Torres, you mentioned that we're in a recession right now. How is the environment today different than the previous recession that we experienced during the Great Recession?
So totally different scenarios, right? This is unprecedented. This recession was caused by a health crisis. It wasn't caused like the prior recession because there was over-financing, something happened, some economic factor caused us to enter a recession. In this case, it was self-induced, a pandemic hit the economy, and we had to close the economy down. So that's a major differences. Also leverages, especially household leverage. The prior recession, of course, it happened after the housing bust. Currently, there was no housing bust also. That's why we see also one other factor, we see that the housing market is doing well. So totally different scenarios. The other one it was a financial crisis. Here it was a pandemic, that we've never seen in the past before. So it's totally different situations going forward. And that brings a lot of uncertainty going forward because the path to recovery depends on how we control the virus and the pandemic. If we're not able to do that, then the recovery is going to be bumpy. And that causes a lot of uncertainty going forward for all of us. For business people, for households, because we don't know what's going to happen because a lot of those decisions depend on health outcomes.
All right, we've got our first question today from social media.
We got a question over from Alessandra on Facebook. Over the years, I hear people trying to say that Austin is in a bubble. From everything I've read, we are not. Could you clarify what a bubble is and how that applies to Texas and in Austin in particular?
So basically the bubble is when the fundamentals are not following the prices. So think about a housing bubble. Think about Jim mentioned this, income, right? Population growth. All of these factors play a role to determine what's going to happen with housing prices. When those fundamentals disalign, right, from prices, and you start seeing, I'm going to plug in an economic word, irrational expectations, right? People are not acting rationally. That's when you have a bubble. There's indications of that. When people start saying, well, what did we see the past Great Recession? People were thinking that prices are going to increase by 10% every year, right? That doesn't make sense. How can prices increase by 10% every year, right? And people start to act on those irrational ideas. that's when you can perceive there's a bubble, right? We've worked here at the center of that. We tried to monitor. We produced an article. You can go to our webpage called "Is Something Wrong with Texas Housing Prices?" where we try to measure home price growth here in the state of Texas, including Austin, and based on those fundamentals I talked about, employment, income, population growth, household growth, to see if there's they're disaligned between each other. And what we found is that there's not a big disalignment, especially in Austin. We haven't seen that currently. So, but also, don't forget, to actually determine when you have a bubble, it's really hard. Nobody, you always do it afterwards, by the way. But right now, by indication, by the strength of the demand, by low inventories, by population growth, income growth, we can see that's what's been driving the Houston housing market and the increase in prices. And don't forget, by population growth, I'm implying also all these people moving from California, all these companies moving from California. They have higher incomes. Think about buying a home, selling your home in California for $1 million and coming to Austin, right? So that pushes up prices also. That movement of companies coming to Austin also has an effect on housing prices.
So after the Great Recession, we experienced a period of population growth and of an explosive energy market. Dr. Gaines, what are some factors that are going to determine how the market responds moving forward into this next decade?
Well, the next decade is going to be extremely interesting for Texas. The prior decade, the decade of the 20-teens, was one of the most remarkable growth decades in the state's history, both in terms of jobs and population, income levels, and in the real estate markets. It's highly unlikely that the decade of the 2020s is going to be able to maintain that same rate of expansion and rate of growth. The population growth, for example, was phenomenal in terms of the number of people being added per year, the number of jobs being added per year, et cetera. That'll be very difficult to replicate. You mentioned the energy sector. We haven't even mentioned that here yet this morning, but Texas, of course, got hit with a double whammy this year. And that is that at the beginning of the year, oil prices were drastically down. The Russians and the Saudi Arabians got together and decided to have a price war, driving the price of oil down. So we were already faced as a state with a declining major industry in the state, that is the energy industry, and a lot of job losses accordingly. Now, that has probably worked its way through, and it's interesting to note that a lot of the so-called experts are quite divided on what they think the energy market is going to look like over the course of the next decade. There are some who say that the price, which is currently hovering around $40 a barrel, will go down into the low 30s or even into the 20s. There are others who are projecting that the price of oil is going to go back into the 70s or $80 a barrel. The answer is, Dr. Torres used the word unprecedented for the time period. It really is unprecedented. We don't really know, we don't really have a model to follow because there's no history of having this kind of a shutdown, this kind of a recession, and then try to extrapolate, well, what happened last time? Well, we should expect something like that in the future. We don't have any history to work with at all. So I'm going to tell you right now, the honest answer is no economist in the world really knows what the heck's going on and where it's going. Everything right now is kind of a guess and sort of a, well, I think it's going to do this and I think it's going to do that. Energy, on the other hand, it also is very highly variable, unlikely to be the driver of another boom in the state of Texas for the next decade. At least it's very difficult to see that, where the demand for oil is slowly going down, alternative energy sources are coming up, and more supply is being produced through fracturing and other methods around the world, not to mention through the United States alone. So don't look for the energy to be that stimulus that we had for the 20-teens. We got lucky in Texas right after the Great Recession. We had an economic driver that the rest of the country pretty much didn't have, and that was hydraulic fracturing. A couple other states, the Dakotas, Wyoming, Texas, we were all fortunate to be able to use that as our driver. We aren't going to have that kind of driver again. So we're going to go back into kind of normal growth mode probably for the 2020s, and then it's a function of how the rest of the economy does, and that's going to be a little bit problematical, particularly the latter part of the decade.
I want to remind the audience to post any questions or feedback on social media. We've got one right now that we'll take.
Brooke from Facebook asks, I'm a broker in the Austin area. We keep hearing that we may see a flood of foreclosures in the next 12 plus months due to the pandemic and homeowners defaulting on mortgage payments or getting into trouble due to deferring payments. Do you have any thoughts on this?
So I think the mortgage bankers just came out with a stat. The last stat I saw is that I think 7.2% of the people from the mortgage bankers are in forbearance. So yes, there's a great uncertainty going forward there, because what's going to happen going forward? Are those people going to be able to pay, their mortgage once forbearance ends? So this is interesting also. So we actually don't know the stat, like how many people actually just did the forbearance to take advantage of the program and not pay their mortgages for the X amount of months. So that's a question that I think it's important to monitor, and we're looking at delinquency rates, because another surprising thing that we've been seeing here is, of course, that delinquencies rates and foreclosures haven't risen during this unprecedented hit to the economy, negative shock to the economy. So it's important to see what's going to happen, the trends we're going to see in forbearance, and those people, what happens to those mortgages when forbearance ends.
Yeah, one of the things that just happened, in fact, I think it just came out yesterday, the day before, FHFA has now allowed homeowners, especially with FHA mortgages, which are predominant or a predominant form of lending here in Texas, but they've allowed through December 31st, they extended it from October 31st to December 31st to apply for forbearance, and that the lenders or servicers are going to be more or less required, that the verbiage there is a little shaky, to allow it for up to 12 months. So a lot of these loans that are currently in forbearance, as Dr. Torres says, there's a lot of uncertainty, because if you're in forbearance because you've lost your job, then you're going to have a problem making that up anytime into the future. If you get your job back and come back and renegotiate your loan and so forth, maybe get some months added to the end and so forth, and pick up where you left off, then that'll work. So the forbearance issue is a major one. It is a major source of uncertainty, to the extent that it's probably going to affect us in terms of foreclosures or distress sales and so forth. I don't think that's going to happen until at least this time next year. I think it's a year away. I don't think the first half of the year we'll see it. I think it'll be the second half of 2021. I can tell you that delinquency rates being reported by the mortgage bankers, for example, are elevated. But one of the reasons for that is because by the statistical methods they're using, they're counting loans that are in forbearance as being delinquent. So that is one of the things, if you see the popular press and it comes out and talks about a accelerated delinquency rate, you got to take it with a little bit of grain of salt, that we know that that's already kind of a bloated number for a different reason than the fundamentals there. But it is a point of uncertainty. We will see more foreclosures than normal sometime in the course of next year, but I don't think it'll be necessarily anywhere near that bad or a problem. One of the good news is that, unlike as we've mentioned before, during the Great Recession, so much of the properties were highly levered, even over 100%. If you owed 105% on your property and you got foreclosed and you're upside down on the loan, that's, you're in trouble. But if you're already well above water on your loan, maybe got 20-25% equity in your home, you'll be able to sell it rather than go through the foreclosure, so the foreclosures won't be as prominent.
All right, we've got time for one more question, and as I mentioned, we will come back to questions that are unanswered with links and further information in the comment section.
We actually have a two-part question from a YouTube viewer. What is your forecast as far as housing prices in Dallas-Fort Worth for 2021 and 2022? And what do you think is going to happen to inventory in Dallas-Fort Worth in the next year or two?
Well, I think Dallas, calling 2022 at this point in time, I can guess with the rest of you. It's really tough to say. I think home prices in Dallas are going to be markedly up this year and probably through next year. The market, the housing market we're seeing, and this, everything hinges on, as we've said a couple of times, but you can't say it too often, everything hinges on how the pandemic and the virus is handled. If we get the virus under control, whatever under control means, it probably isn't going to be eradicated, it isn't going to go away, but if we have some kind of vaccine, if we have some kind of medical treatment for if you get it and so forth, but if we get the pandemic or the virus, the COVID-19 under control, the market is going to continue to go on, and quite frankly, on through next year, Dallas is going to continue to do well. Percentage growth numbers, probably 2021 looking similar to this year, because the demand is still there. Dallas is still a robust market. Employment is still high. Population growth is still coming there. The demand for housing is still being created. And as the economy opens up more and more and we go back to quote unquote normal, I think you're going to see that market continue on. The 2022 difficulty is, the difficulty there is figuring out what's going to happen with the national economy that's going to be impacting Texas and the Dallas area. That's a tougher call. If the national economy can continue to go on and keep on going and keep on going, then Dallas will do just fine. But that's the variable there that's really difficult to call at this point.
So moving from Dallas to the rest of the state, Dr. Torres, what are we expecting to see from the housing market in 2021?
So I'm going to use the old economic phrase, it depends, right? Jim mentioned this earlier about the pandemic, right? How is the pandemic handled? And that will allow us, right now we're in a recovery, right? We're recovering, the economy is recovering, we're in a recovery path. And the strength of the recovery, and if that recovery continues, is depending on health outcomes, right? So let me just start by saying that. Now, but there's a lot of positives for the housing market. Jim mentioned this first one. We have all these millennials coming into the market. So that's the positive, demographics. Then we have interest rates are going to continue to be low going forward, right? So that's another positive. So also, Jim mentioned this, the change in preferences. People want to move to a house. They want to live to a house. They want to be there, right? They don't want to be in a apartment. That preference change for that. So we have all these positive factors. And again, the recovery is coming back, employment is coming back, less certainty. So all these factors play a role to saying that the outlook is positive for 2021 for the housing market.
All right, we've got one more question from social media.
Matt on Facebook asks, could you speak to the housing expectations for some of the smaller markets like College Station, Tyler, Wichita Falls, etc.?
Yeah, right now, a lot of the smaller areas, particularly the ones that are around, just outside, if you will, the sphere of influence of the major markets, outside of the sphere of Dallas or Houston or the I-35 corridor of Austin and San Antonio kind of combined. Those smaller markets are doing quite well, and a lot of movement. Luis was referring to the change of preferences. Buyers are changing preferences about space needs, but also spatial needs, where they like to live and so on. Some of the other areas, a little more further out, the ones that are energy dependent, Midland, Odessa are still kind of fighting and struggling a little bit, and Portland, Port Arthur and Beaumont, because of the energy factors that are there and that the dominance of the energy industries. in those particular markets. Most of the other markets are doing pretty well and are simply maintaining what they have been doing in the past couple of 3 years. It's a lot of variation. We have 25 MSAs in the state of Texas. I've forgotten how many micropolitan areas, that's 10,000 or above in the counties, but it's a whole bunch of them. So it's a very wide distribution and change. One area can be doing much better than another area because of local conditions.
Yeah, overall, there's a lot of uncertainty going on, but at the Real Estate Center here, we're putting out a lot of research and products to try to keep the Texas real estate market informed and what's happening in the economy overall. On behalf of the Real Estate Center, I'd like to thank everybody for joining us in Texas Real Estate Today. And I encourage you to go back into our social media comment section to look for links and additional information to some of the questions we didn't get to. Additionally, you can contact Dr. Gaines, Dr. Torres, or myself via email. And as always, you can reach out to us and contact us on any of our social media platforms. Thank you very much and have a great day.